AT&T has a dividend about $2.04 per year. So it's about a 7% dividend yield, but they're only making, as of now, this is based on the past 4 quarters, $1.97. And so AT&T is not really making enough at this point to completely cover their dividend. AT&T also recently completed the acquisition of Time Warner, so they have just a massive amount of debt. And in this kind of environment, when you see the economy slow down dramatically, this is when too much debt, or as we call it, too much leverage, and too big of a dividend become problematic. Because if AT&T decides that business is slower, they have too much debt to pay off, their interest expenses on their debt is very high, or is a lot. I'm not saying that their interest rates are very high, but the amount that they have to pay is a lot. So they might actually look to cutting their dividend a little and say, well, right now it's just about a 6.7% dividend yield. If we cut that dividend yield down to 4%, we'd still be a little bit more than double the S&P 500 dividend average. And it's, nobody could complain about that, and they'll try to conserve cash. I don't think that would be particularly good for the stock, but the real problem is, and this is why I think this is such an important topic, dividend investing, because if you're the baby boomers, retirees, soon to be retirees, that is the population that really looks to passive income, because they're thinking they want passive income to replace their job, to replace their active income when they retire. So a lot of people take a look at a stock like an AT&T, and there are many other examples, and they say, wow, that's a great dividend yield. I need to own that stock because of the dividend yield. But and they say things, oh, but it has a great yield. It's got a 5% dividend yield. It has a 4% dividend yield. That's AT&T. And then the stock went down. Then it had a 5.5%. And the stock went down. Then 6%. Stock went down. Now it's almost a 7% dividend yield. Maybe soon they'll be saying it's a 10% dividend yield because the stock keeps going down. What I say to these people is, the company pays about $2 a share, $2.04, but let's round it to $2 a share. If the stock goes from 30 some odd dollars a share to 29, you lose over a third of your assets that you have in AT&T. Stock's down $10, $11, $12, but big whoop, you have to wait an entire year to get the $2 dividend yield. And that's what happens when people chase yield. And I've seen this. Look, I've been doing what I do now for 30 years, and I've always seen retirees and soon-to-be retirees make the same mistake in every cycle. They do something called chasing dividend yield. So they buy high-yield stocks. If you're a retiree and you're chasing after higher dividend yields and you're really looking to get paid as much passive income as you can on your investments, think of it like this: too much of a good thing is not a good thing.